Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. Welcome to August. We just closed out July last night. Ankerstar Wealth hitting on all cylinders. Got a new high across the book, just under 93 million. Now that we're managing, so kind of impressive month for us. And hoping to look forward that the things keep going with some of the stuff we're going to talk about today, with potential rate cuts on the horizon. So our first topic today is going to be, what did Chairman Powell say yesterday during the Fed meeting conclusion and the Q&A session, and what does that mean for the markets? And then after the market closed yesterday, Meta crushed earnings, so they're up nicely today. Mike's going to talk about that. That is in our model. Meta is in our models, and we have a bright forecast for Meta out there. And then lastly, though, we're going to talk about a little bit of the negative impact of inflation is, inflation is bad for everybody because things cost more, but of course that adversely affects those that have less. So we're kind of in a country already where you can see a pretty big economic divide, and inflation's, the situation with inflation is adding to that. So that's our three topics for today. Before we get started with financial education presentation, you have to do your own due diligence before acting upon anything you hear in this presentation. More disclosure information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. Let's start with me and get through my tech issue here. There we go. And not quite yet. Working through tech issues. All right. Stop sharing. Yes. Share. Had to do some approvals here. And off to the market. Here we go. You should be seeing CNBC.com. This is a live shot from this morning. You can tell the NASDAQ's up, and we're tech heavy, so NASDAQ up means the book's up for us. But specifically, you see the banner, the 10-year Treasury drops below 4% for the first time. So we're going to talk about the Fed meeting here in a second. Remember, the Fed sets that 2-year rate, the rate that the banks loan to each other, and the market sets the rest of the yield curve. So not to geek out too much, but things, the yield curve can start to be less steep because of the anticipated rate cuts that are coming. Hopefully, we shall see. Here's the articles on CNBC for the Fed decision. Yesterday, they didn't do anything. They held steady. They claimed progress, and specifically, Chairman Powell mentioned the September meeting that if he gets what he wants as far as, or what they hope to see as far as continuing progress across the board, inflation, unemployment, economic growth, those are big three that they're looking at, is that they will start to cut rates. So what does that look like on the chart? Let's show you. Here's kind of the 25-year history in the target fund rate. You can see that in 2022, we had that series of raises where we went from literally zero up to the 5.25 level. Well, that's largely slowed things down, slowed inflation down. It's also tried to slow the economy down. But if you notice, the last couple of periods that when we started, what's interesting is a lot of people think, well, it's the rate increases that causes the recession. And that's probably true, but it's a lagging indicator, right? So if you go back here to 2000, obviously before the chart shows, rates were raised above 5%. And then notice when the rate cut started, that's when the recession hit, even though it wasn't a very long recession. That's when the recession hit. Same thing going in, we had the global financial crisis as they started cutting rates. Looks like August of 2007, but then the recession hit. COVID was a little bit different, right? That was kind of a one-off event, so really not much to learn there. But so I could expect to see that, in a perfect world, we're able to have that soft landing. That means no recession, but certainly once we start dropping rates, they will get the all-time credit if they can manage to avoid at least a little tiny recession going into 2025 out there. Strength of the economy is good. Unemployment is good, even though it's starting to weaken a little bit. So overall, things are, if the Fed can pull this off, it's going to be pretty masterful. What does it mean to you? So on the September meeting, so again, roll forward 6 weeks to the middle of September, when that rate cut does go down by 1/4 point, which is the anticipated amount, that doesn't mean your credit card rate is going to go down significantly. It's really not going to move the needle across the board, because a lot of it's getting priced in right now. It's really that series of rate cuts, which will likely take us into 2025 before you actually see something. Car loans are up at 8% still. The mortgages are just below 7 right now. So again, we should start to see it get better, but nothing will change overnight in your life once we have that big announcement. But the market will likely celebrate it. So, all right. Speaking of markets celebrating things, I will stop sharing, turn it over to Mike, and he can talk about Meta earnings from last night, where Zuck continues to do his thing and make us some money. So over to you, Mike.
Yes. Just in case you ever get criticized for scrolling on social media and someone's like, you shouldn't be doing that, it's a waste of time, you say, I'm making money because I'm an owner of Meta or Facebook. Yes. So let me share the good news. And you can see that Meta is up almost 10% today. You can see the graph on the year, it took some drops back in May. And at that point, we believe that Zuckerberg was kind of throwing in the kitchen sink saying, this is wrong, this is bad. It's kind of like come out with all the bad news and then go up. Took a little bit of drop with the rest of tech during July, but then it's already up near all-time highs again. So that's great news. So let's get a little bit into why that happened. And I love this headline. Advertising growth is proof that hefty AI spending is already paying off. And that is the thesis over the last year and a half, is that AI is taking off. But it's more than just NVIDIA and more than just ChatGPT. It's like, how does it actually help the business? We know it's an expenditure, but how does it help the business? And we're seeing with Facebook that they're actually converting it into sales. So there's your justification for scrolling. You're looking at ads, you're clicking on things. You might not realize that side, but you're just connected with friends and showing pictures of what you ate for breakfast or whatever. But anyways, Meta converts that into dollars. And if you are an owner, you've experienced that. Meta is a great example of, why don't I just play the QQQ or the NASDAQ versus why do I buy an individual stock? And I want to show this graph because this is a year-to-date graph of Meta against the NASDAQ. And Meta is that green line. So you can see year-to-date, certainly a lot more volatility when you play an individual position or you invest in an individual position. You can see the drop in May, the NASDAQ barely down, Meta dropped off 10, 12%. You can see the drop in July, and you can see the rebound. But overall, year to date, a much better performer, a leading performer within the NASDAQ. So, we get those questions. In more aggressive portfolios, we are purchasing individual positions like this. And I want to bring this up as an example is, we have an investment advisory board at Ankerstar Wealth. And I know that the topic came up only 2-3 months ago about expanding our position in Meta. And based on our board's expertise, we already had it within our model, but the recommendation is, yes, we should expand that position. That was something that we implemented based on the board recommending, and that paid off. And so it's not just one person making a recommendation, but really a team environment. And I get to give a board update later today, so I'm looking forward to telling the board that, hey, that paid off. So nice. Another thing that we all hear about, inflation. And I saw this article on in today's Wall Street Journal, so I'm bringing up the electronic version. 10 years ago, 20 years ago, I would have thought, oh, inflation, it just affects everybody the same. If all prices go up at 9%, everyone just pays 9% more. But there's another side to that. And the side is the haves and the have-nots. If you are just living paycheck to paycheck and prices go up, say your salary goes up 5% and the cost of goods goes up 9%, you are making less purchasing power-wise than you were before. And where it really comes into play with inflation is home ownership and stock market or ownership of business wealth. Because if you, in the last, before 2 years ago, if you locked in a mortgage at 3% or whatever rate, whatever low rate, even though inflation went up, the value of your house went up, but your actual, mortgage payment did not. It was fixed. So therefore, the biggest component of inflation, housing or rental income, rental costs, you were not affected by. But if you were renting an apartment or whatever, those costs get passed on to you. So that's one side of it. The other side is stock ownership. So if you own stocks and they make more money and their stock price goes up with inflation, you reap the benefits of that. So when you look at this, and this is a great paragraph, the stock market is soaring. Household wealth is at record levels and investment income has never been greater. At the same time, some families' pandemic era savings are running dry. And this is scary to me. Delinquencies on credit card and auto loan payments have jumped. And I've looked at some graphs that this is happening. Credit card 60-day plus, late payments is going up. So that means people's cash, week to week payments, they're running low. That government gifts that happened a few years back is gone, and people have run through that, and now it's starting to go up. This is one reason that the Fed is likely, I think I saw an 83% chance maybe to lower the discount rate in September. Who knows if that happens, but it's to try to stimulate the economy. I know the GDP number came in at 2.8%, which is fantastic. I wouldn't be surprised if that gets revised at some point. It surprised me that it was that high because, the second paragraph, warning signals are flashing for more low and middle Americans, exposing this division. And we're seeing this in, stocks like McDonald's and Starbucks and Target, where they're not coming in quite as high revenue-wise as they expected. And that's more pulse on on middle America. So that's where the inflation is really, really hurting people. So, recommendation, obviously, 20 years ago, put your money in stocks and invest, but that, we'll start today. The biggest thing is if you can be an owner of a house, owner of a company via the stock market, these are great ways to hedge against inflation. Inflation is not fair. It does not affect everybody equally. It hurts low and middle income Americans the most. And, it's nothing you can do. I mean, nothing we can do about it. We can just try to, hedge against it. So anyways, Steve, what do you got on that?
No, I mean, you're right. It's an ownership deal. And so what's your strategy, right? Or what's your strategy for your children? Because, the home ownership thing is super tough because, it was doable for us, our age. You were taught, get your job, save your 10% was kind of the common savings rate, and you could work up towards a down payment for a house. That goalpost is moving further away. So when I look at my kids being 19 and 17 now, it's like, man, home ownership, if they're going to buy in this area and not, 50 miles out of town, the parents are going to end up helping out in most cases, just because the salary and the savings rate, you'd have to save like 35% to be able to, spend your 20s working towards that down payment. So by the time you're 30, you could buy a house. So just as a parent, kind of think about that sort of thing. And then secondly, I like to explain it, especially when I'm talking to young folks about investing, it is an ownership society, right? So the sooner you can get there, in high school, you work entry level if you have a job, and you think if I could just get to be my shift supervisor, my life would be great. And then it's like shift supervisor. When you get there, it's like you look at the manager and you're like, man, if I could just be the manager, that would be great. And then you look it up towards the general manager. Well, you can go down that road if you want, or you can skip to the ownership level by buying stock. So that's where you skip all that other stuff and you share the ownership proceeds. So I thought you laid it out there pretty well, Mike, that you're right. When you own things, they inflate right with inflation, so you aren't hurt nearly as bad. You're just annoyed. Versus if you don't really own assets, then you're pretty well hurt. across the board by inflation. So it'll be interesting to see how it all plays out. That are we going to have a recession or not? Well, maybe it's a recession in certain areas of the economy, certainly. So, all right, a lot to think about today, but let's get back to the green that's out there and celebrate that. Meta carrying the market higher, and specifically the tech sector, and let's hope that continues on a roll. With that, we'll be back with you guys tomorrow. You have a good one. Bye.